Something strange is happening in the silver market, and almost nobody in the West is talking about it. Right now, at this very moment, silver buyers in parts of Asia are paying significantly more for the same metal than buyers in the United States. Not a different product, not a different purity. The same silver, same ounce, same element pulled from the ground. Yet the price gap keeps widening. And if that doesn't immediately make you uncomfortable, it should. Because markets are not supposed to behave this way. In a connected global system, price differences are supposed to close fast. Arbitrage traders live for these gaps. Banks exist to smooth them out. Exchanges are designed to make sure price discovery is uniform. When that system works, silver in New York and silver in Shanghai should never feel like two different assets. But today, they do. In Asia, physical silver is being treated like a strategic resource. In the US, it's still treated like a line on a screen. That difference, that mindset, is the entire story. Most American investors are taught to believe silver has one price. You pull up a chart, you see a number. You assume that number represents reality. But that number is not the price of silver. It's the price of a promise, a paper claim, a derivative settled in cash, not metal. In Asia, buyers don't care about paper promises. They care about delivery. They ask a very simple question. Can I hold it? If the answer is yes, they pay up. If the answer is no, the price is irrelevant. This is why the split exists. In the US, the dominant silver price is discovered on futures exchanges. These markets trade enormous volumes of silver that doesn't exist in physical form. Contracts are rolled, settled, and offset without metal ever moving. Liquidity is high, leverage is massive, and confidence, at least on the surface, looks strong. In Asia, especially in places like China and parts of Southeast Asia, silver trades differently. Physical exchanges matter. Inventory matters. Supply chains matter. When demand spikes, the price reacts immediately because metal has to be sourced, shipped, and delivered. There's no infinite supply of paper silver to absorb stress. And right now, stress is building. Industrial demand for silver is not slowing down. Solar panels, electronics, medical applications, defense systems, they all require physical silver. Not ETFs, not futures contracts, metal. At the same time, mining supply is tight. New discoveries are rare. Production growth is slow. Recycling can't fill the gap. So when Asian buyers see rising demand and limited supply, they respond rationally. They secure metal now, even if it costs more. In the US, the reaction is delayed. The futures price suppresses urgency. It creates the illusion of abundance. As long as contracts can be settled in cash, the system can pretend nothing is wrong. But here's the part most people miss. This price split isn't just about silver, it's about trust. Asian markets are showing you what silver is worth when trust in paper claims starts to erode. American markets are showing you what silver looks like when trust is still assumed. Those two realities cannot coexist forever. Every time someone in Asia pays more for physical silver, they're sending a signal. They're saying, I don't believe this paper price reflects future availability. And every time the US market shrugs and keeps trading contracts, it's saying, we believe the system will hold. History tells us what happens next. When physical demand keeps rising and paper markets keep expanding, eventually the paper market has to answer a question it can't avoid: deliver or default. And when that moment comes, the price doesn't adjust gradually. It gaps, it reprices violently. It moves to where physical buyers have been signaling all along. The silver price split is not a glitch. It's not a regional anomaly. It's not a temporary inefficiency. It's a warning. And the longer it lasts, the louder that warning becomes. The most dangerous thing about this silver price split is not the number itself. It's how calm everything looks on the surface. Turn on financial television in the US and you'll hear the same recycled talking points. Inflation is cooling. Markets are stable. Commodities are range-bound. Silver is underperforming. Nothing urgent. Nothing broken. But calm is exactly what systems look like right before confidence cracks. Because confidence doesn't collapse loudly at first. It erodes quietly, one decision at a time. One buyer choosing physical over paper. One manufacturer locking in supply early. One central planner deciding they would rather hold metal than promises. That's what Asia is doing right now. In many Asian cultures, silver isn't just an investment. It's a store of value with memory. It's insurance. It's something you pass down, not something you trade on margin. People there remember currency resets, capital controls, bank holidays, and sudden rule changes. They don't need a textbook to understand counterparty risk. They've lived it. So when supply tightens, they don't wait for confirmation from analysts. They act. This is why premiums in Asia rise first. This is why physical inventories drain faster there. This is why refiners and wholesalers prioritize those markets when metal is scarce. They know payment is real, demand is real, and delivery matters. Contrast that with the US system. In America, silver has been financialized into abstraction. You can buy exposure without ownership. You can trade volume without consequence. You can sell silver you don't have, settle in cash, and move on. The system rewards speed, leverage, and confidence, not preparation. As long as nobody asks for the metal, everything works. But the moment enough people do, the illusion breaks. Because here's the uncomfortable truth. The paper-silver market is many times larger than the physical supply it represents. This isn't speculation, it's structural. Futures contracts, options, ETFs, swaps, they all reference silver, but very few require delivery. The entire structure depends on most participants never wanting the underlying asset. Asia is challenging that assumption. Not loudly, not politically, but economically, every ounce pulled out of circulation tightens the system. Every shipment redirected east reduces buffer inventory. Every long-term contract signed outside Western exchanges weakens the paper price's authority. And slowly, the question changes from what is the silver price to which price matters? The one quoted on a screen, or the one paid by people who actually need the metal? Industrial users already know the answer. They don't care about spot price if they can't secure supply. A solar manufacturer can't install futures contracts on rooftops. A defense contractor can't solder with an ETF. When physical silver becomes harder to source, cost becomes secondary to availability. That's when premiums stop being optional. This is also why the arbitrage everyone expects doesn't fix the split. In theory, traders should buy cheap silver in the US and sell it at a premium in Asia. In reality, that process requires metal. It requires transport. It requires inventory that actually exists. Paper arbitrage doesn't move atoms, so instead of closing the gap, the system absorbs it. The futures price stays tame, physical prices rise, and the divergence grows large enough that even casual observers start to notice. At that point, psychology shifts. People begin to ask why two prices exist at all. They begin to question which one reflects reality. They begin to reconsider the role of silver in a world where supply chains are fragile, geopolitics are tense, and trust is no longer free. That's when behavior changes fast. Because markets don't move on data alone, they move on belief. And belief can flip suddenly when enough people realize the same thing at the same time. The silver price split is doing something subtle but powerful. It's re-educating the market. It's reminding participants that metal is not an idea. It's not a chart. It's a finite resource with real-world constraints. And once that lesson sinks in, it can't be unlearned. What looks like a regional pricing anomaly today can become a global repricing tomorrow. Not because someone declares it so, but because reality eventually asserts itself. When that happens, the question won't be why Asia paid more. The question will be why everyone else waited. By the time the rest of the world fully understands what Asia has been signaling, the opportunity will already be gone. That's how these shifts always work. Not with headlines screaming panic, but with quiet accumulation followed by sudden realization. The people who move first don't do so because they are emotional. They move because they are pragmatic. They see constraints forming, incentives changing, and systems leaning too heavily on assumptions that no longer hold. Silver is one of those assumptions. For decades, the market has been conditioned to believe silver is abundant, replaceable, and easy to source. The paper price reinforced that belief. Low volatility created complacency. Every dip was met with more contracts, more liquidity, more reassurance that nothing fundamental had changed. But fundamentals have changed. The world is using more silver than ever before, and it's doing so at a time when supply growth is limited. Energy transitions are metal-intensive. Electrification is silver-intensive. Security, healthcare, and data infrastructure all depend on properties that silver uniquely provides. There is no perfect substitute at scale. At the same time, geopolitical fragmentation is reshaping trade. Countries are prioritizing domestic supply chains. Strategic materials are being secured ahead of need. Trust in global just-in-time delivery is fading. In that environment, physical control matters more than theoretical access. Asia understands this instinctively. That's why physical silver is being pulled into long-term holdings, industrial stockpiles, and private vaults. Once silver enters those systems, it doesn't cycle back quickly. It disappears from the trading float. The visible supply shrinks, even if the paper market pretends nothing has changed. This is how shortages begin. Not with empty shelves, but with thinning margins. And when margins thin, behavior changes. Producers start negotiating longer contracts. Buyers start accepting higher prices to guarantee delivery. Intermediaries stop selling forward what they can't replace easily. The system becomes defensive. Paper markets don't adjust well to defense. They are built on confidence, not caution. So the split widens further. At some point, Western markets will be forced to respond. Not because they want to, but because physical demand will no longer be ignorable. A delivery failure, a contract settlement that quietly shifts to cash, a sudden premium spike that can't be explained away. It only takes one crack. When that happens, price discovery migrates. It moves away from leveraged paper venues and toward places where metal actually trades hands. The authority of the old benchmark fades, and a new reference takes its place. This is not theory. It has happened before in other commodities. It happens whenever financial abstraction stretches too far from physical reality. Silver is simply next, and when the repricing comes, it won't be polite. It won't wait for retail investors to catch up. It won't move in orderly steps. It will jump to where the market should have been all along. That's why the silver price split matters so much. It's not telling you where silver was. It's telling you where silver is going. Asia isn't paying more because they're irrational. They're paying more because they understand risk. They understand scarcity. They understand that when everyone wants the same thing at the same time, price becomes secondary. The United States is still pricing silver as if trust is unlimited and supply is endless. That belief has worked for a long time, but no belief survives contact with reality forever. When the two prices finally converge, they won't meet in the middle. They'll meet where the metal is. And by then, the question won't be whether silver is undervalued. The question will be who recognized the signal early and who ignored it when it was still quietly visible.